Hi everybody, and welcome to our first video in Chapter 10. Here we're going to be looking at responsibility accounting systems. All right, so decentralization in organization. What are the benefits? Well, number one, top management is freed more to concentrate on strategy. Number two, lower level decisions can often be based on better information. Number three, lower level managers can respond more quickly to customers. And number four, lower level managers gain experience in decision making. And five, decision making authority leads to job satisfaction. Very important when you feel like you're the master of your own destiny. Okay, but there are some disadvantages. Lower level managers may not make decisions without seeing, they may make decisions without seeing the big picture. There may be, number two, a lack of coordination among autonomous managers who may have different goals and objectives that may not be consistent with the upper management's big picture view. Number three, lower level managers' objectives may not be those of the organization. And number five, it may be difficult to spread innovative ideas in the organization. All right. Responsibility accounting systems link lower level managers' decision making authority with accountability for the outcomes of those decisions. Managers are held responsible for those items, and only those items that the manager can control. Very important. A responsibility center is used for any part of an organization whose manager has control over and is accountable for cost, profit, or investments. Those three pieces: cost, profit, or investments. So let's take a look first at the cost center. Here, that's a segment where the manager has control over costs, but does not affect revenues or investment funds. So a profit center is a segment whose manager has control over both costs and revenues, but not over investment funds. Some revenues might include sales, interest revenue, other revenues. Costs might be manufacturing costs, sales commissions, salaries, and maybe some other costs. So an investment center has a manager whose control is over cost, revenues, and investments in operating assets. Investments in operating assets. So let's take a look at computing return on investment, ROI, and show how changes in sales, expenses, and assets affect ROI. How do we calculate ROI? The formula for that is the income before interest and taxes. We'll call that EBIT, earnings before interest and taxes. And so we take the net operating income, EBIT, and divide it by the average operating assets. Okay, the average operating assets include cash, accounts receivable, inventory, plant and equipment, and other productive assets. Net book value versus gross cost. Most companies use net book value of depreciable assets to calculate the average operating assets. How do we get that? I think you know by now. We subtract accumulated depreciation from the original acquisition cost of that asset to get to the net book value, sometimes called carrying value or simply book value. All right, so here we have the definitions. ROI, we have net operating income divided by average operating assets. Our margin is the net operating income divided by sales. And turnover is sales divided by operating assets. So you can see that ROI can be expressed by taking the margin times the turnover. And these sales will cancel out when we do that, leaving us with net operating income divided by average operating assets, as is the formula for return on investment. Okay, let's take a look at an example of increasing ROI. The Regal Company reports the following. We have net operating income, we have average operating assets, we have sales, we have operating expenses. What is the Regal Company's return on investment? Okay, we can take the net operating income times, which is the margin, times the turnover, sales divided by operating. Okay, and if we do that, we'll take 30,000 divided by 500,000. Let's go back. Here's the $30,000 net operating income divided by sales here. And then we'll multiply it by sales, 500,000, divided by the average operating assets, which are here. So now you can see how that comes together. We take 30,000 divided by 500,000. That equals 6%. We take 500,000 divided by 200,000. That gives me 2.5. So I multiply the two together, I get 15% return on investment. Okay. So here we're going to look at investing in operating assets to increase sales. Here we assume that Regal's manager invests $30,000 in a piece of equipment that will increase sales by 35,000 while increasing operating expenses by 15,000. So now we have the same, we have net operating income, average operating assets, sales, and operating expenses. So let's look at the new ROI. Remembering these numbers, we're going to take our return on investment, which will be 50,000 divided by 535,000. Where did we get that? Here's our 50,000 net operating income and our sales 535,000. And then we take the same 535,000 divided by our average operating assets here. And we multiply that through and we get 21.8%. So initially we had 15% return on investment, but that increased to 21.8% by pursuing that strategy. Okay, and that 15%, you'll remember we calculated back on the previous slide. That was our original 15%. Okay, so criticisms of ROI include, in the absence of balanced scorecard, management may not know how to increase ROI. Balanced scorecard includes input from a variety of different sources, fairly complex subjects. Books have been written on that subject, and I won't go through it in any depth here, but a very sophisticated way of evaluating management and how they perform, looking at it from a customer perspective, from a profit perspective, etc. Managers often inherit many committed costs over which they have no control. Managers that are evaluated on ROI may reject profitable investment alternatives. So for example, let's say that you have a project that will result in a 12% return on investment, but your current ROI is, let's say, 14%. And 12% is below 14%. And if we pursue the project, it'll erode that 14% to, say, 13% or something like that. If a manager is being evaluated on that and someone looks at 14% being eroded to 13%, they may be evaluated negatively, whereas 12% is looking pretty good to the company as a whole. So you can see why ROI would need to be carefully evaluated when using it in valuations. Okay, so now let's look at residual income and explain its strengths and weaknesses. Residual income is the net operating income above some minimum threshold for return on operating assets. So here's our net operating income. Here's our average operating assets. Here's the minimum required rate of return. Okay, so this computation differs from ROI. ROI measures net operating income earned relative to the investment in average operating assets. Residual income, on the other hand, measures net operating income earned less the minimum required return on average operating assets. Okay, so let's take a look at that. An example would be the retail division of Zephyr Incorporated has average operating assets of $100,000 and is required to earn a return of 20% on those assets. In the current period, the division earns $30,000. So let's see what the residual income might be. Okay, so if I take $100,000 and my required rate of return is 20%, I need to make $20,000 minimum. But my actual was $30,000. If I deduct my minimum from that, I come back to my residual income of $10,000. So residual income encourages managers to make profitable investments that would be perhaps rejected by managers using a simple ROI formula. Let's look at Redmond Awnings here, a division of Wrap-Up Corporation, and it has a net operating income of $60,000 and average operating assets of $300,000. The required rate of return for the company is 15%. What is the division's ROI? Okay, I'll give you a second to compute that. And if we compute that, we're going to find that it's 20%. We take the net operating income here of $60,000, right? And divide that by 300,000 of average operating assets. That gives us 20%. Now, if Redmond Awnings does the same kind of thing, if the manager of the division is evaluated based on ROI, will she want to make an investment that would generate only $18,000 per year? And the answer to that would be no, because it would be less than 20%, but still probably a good investment. We take the 18,000 here and divide that by, I should say we take the 400 and I'll try this again. We'll take the 78,000 and divide it by 400,000. That looks like a good place to stop this video. And when we return, we'll continue on. Until that time, bye for now.